Hi students, so today let's look into efficiency ratios. So over here we'll be talking about three ratios, that is receivable days, payable days and inventory turnover days. So looking into receivable days, it indicates the average period it takes for a company's debtors to pay for its purchases. That is, how long does it take our receivables department to collect our receivables? The receivable days are decided by our company, and we'll always try to keep it low because we want to get our receivables sooner, or else it may turn into bad debts. So most of the companies will try to collect their receivables as soon as possible. Then why not keep the receivable days at its minimum? See, when you reduce your receivable days, there is a chance that it may affect your sales. Why? Because if your receivable days are very low, the customer may look for other options where they provide more receivable days. So you may lose that sale. So it is always good to reduce your receivable days, but only to a point where it does not affect your sales. Now, if your receivable days are very high, you can say that your receivables department is inefficient in collecting your receivables. Or there are other situations like underlying situations, like if there is a recession or if there is a flood or if there is COVID. In these situations, you are ought to increase your receivable days to create more sales in such a what do you say, difficult situation. Or you can also think about your customers that they won't be able to pay in such a difficult scenario. That's why you may increase the receivable days. This is the only time where you purposefully increase a receivable day, or else it is always you try to keep it at minimum, but not to the point where it affects your sales. Okay. Then talking about payable days, it indicates the average period it takes for a company to pay for its purchases. So we have to understand that we are not the one deciding on payable days. The payable days is decided by the supplier. So if the supplier trusts us, he'll give more days for us to pay back. But if the supplier does not trust us, then our payable days will be lower. So looking at the payable days, we can talk about our credit worthiness. So in the ratio analysis, I want your students to talk about credit worthiness about your company. So if you have got a greater payable days, then you can say that your company has more credit worthiness and the suppliers trust your company more. If you have very low payable days, then you have to say that your company's credit worthiness is low and the suppliers don't trust your company much. But there's an exception. See, if the supplier is giving you a discount, early settlement discount, then those are the situations where you pay early. Okay. If that mentioning is there in your question somewhere, then you can write up this point. Or else, then again, talking about the underlying situations like recession, COVID, earthquakes, and all these stuff, whereby you don't have any control over it, that's when your payable days can increase. Does not mean that your credit worthiness and suddenly your suppliers started trusting you. It is not that. It is because of this difficult situation in the market, suppliers are ready to give you more days. There is, then you should not talk about your credit worthiness. Instead, you have to talk about the difficult situation in the market and why the suppliers have given you more days to pay back. Okay. Then looking at the last one, that is inventory turnover days. It indicates the average number of days that inventory items are held, or the average number of days it takes to sell our inventory. So less lower the days, it is much more better because we are able to sell off faster. But that does not mean that it should be very low, because very low tends to take a company into over trading, which is not good. So it should be kept at a minimal point. But if your inventory days are increasing, that means your inventory holding period is increasing automatically. We have to say that the more time it takes for your inventory to leave the company, that means you have to store it. There are extra costs incurring on that inventory, and there are chances you may face a loss. And you have to also talk about the inefficiencies of your sales department, whereby it is not able to make sales in the committed days. Or you have to talk about the slow movement of your product. So these might be the reasons. Sometimes when pricing will affect. Okay, see, if your gross profit is very high, that means you have priced your product also high. So that may internally affect your sales. That because if your pricing is very high, demand is tend to go low. So your inventory turnover days may increase. So you have to even check that. Go back to your profitability ratios and then check into your profitability ratios whether you have kept the gross profit ratio high. Or sometimes the inventory turnover days starts reducing. That may be also because of the same reason you have kept the gross profit ratio low, whereby intending that you have reduced the selling price, creating more demand for your product, and that's how your sales have increased. So you have to always visit back into your profitability ratios to check whether it has any connection over there. Okay, so these are the points you must look into when you're writing the efficiency ratios. So we looked into three ratios. The first one was receivable days, whereby we talk about the efficiency of a receivable department. The second one was the payable days, whereby we talk about our credit worthiness, and the third one is inventory turnover days, where we talk about our sales department as well as our pricing department. And we also look into the underlying situations in all of these three ratios, whereby if there was a recession, or if there was a COVID situation, if there was a pandemic, war, or something like that, that is not under our control, then we have to write a different answer pertaining to that situation, or else these will be the reasons. Okay, okay, bye, take care.